Today, it's all about finance, economics, banking, and politics. Look at all that's happening on the world stage. There's Greece, there's Ukraine, there's Israel, there's Iran, there's ISIS, there's hotspots all over the place. Is it possible there are a handful of people actually pulling the strings on these events? And are they also in control of financial markets, even nations? So what does all this have to do with you and the kind of life your kids, your grandkids are going to live? Well, Bob Rinear, here's our guest today. He's going to explain how a little knowledge of the interweaving of world events can actually give you a great advantage in the financial markets. Let me tell you a little bit about Bob. Bob Rinear's introduction to the financial world was buying gemstones, gold, and silver for his daily jewelry business. And he saw gold back in the 80s starting to soar, and he began to wonder, why are the prices going up so much? And what he discovered was that political issues and global economics were actually stimulating those prices. And so as his knowledge grew, he invested in training, but none of the classes gave him the entire picture that he was looking for. So over time, Bob developed his own trading style that began to produce profits. So Bob, I'm looking forward to hearing a little bit about this more. Welcome to the show.
Well, thanks for having me on, guys. Glad to be here.
Tell me a little bit about that gold trading, what you discovered under the wraps.
I came out of high school determined to be a jeweler for some reason. It wasn't in my family or anything. I was just intrigued with gold, diamonds, and the whole idea of the jewelry business. And I actually went to school for it. And when I had come out of school, I opened a repair shop, and I was doing contract work for a bunch of different stores. And eventually I ended up opening my first retail establishment. And when you have a jewelry store, every time you sell something, you've got to replace it. And I'd call the supplier, and the price of it, like a gold chain, it would be different from the day before. And I'd go, okay, why? Well, the price went up. Well, I know that, but why? And they'd give me this, malarkey, and it didn't make any sense. And as this was going on in the late 80s, I had to fess up to myself and sit down and say, you know what, Bob, you really don't understand anything about global economics. You just don't. You're a jeweler. And I set out to change that. And I went to economics classes. Well, they taught me some things, but still didn't tell me why my gold was going up and down like crazy. One thing led to another. That was my introduction into the financial markets, and I got fascinated with it. And over the years, the jewelry business I sold off, and I got full-time into the financial arena, and here I am today.
What did you discover? What were some of the hidden things that were impacting the fluctuation in gold prices?
That's a great question. And the thing that was so odd about it was, we had all been told that we had come off the gold standard, so, why would nations around the world really care that much about this stuff? And yet what I was finding, that central banks were still shipping tons, literally tons, metric tons of this stuff back and forth between nations to settle accounts. So I was like, okay, I thought we were off a gold standard in 1971 when Nixon closed that window. So what I came to find out, and is still true to this day, in fact, we should talk about that a little bit in a little bit, is that gold, although we don't use it on a daily basis, is indeed still considered a money at the higher end, at the elite end of the global banking system. And that's what the central banks often do indeed still use to settle accounts across the world. And therefore, if you've got war, if you've got really ugly things going on in certain hotspots, you'll see the central bankers making these changes to gold allocations. And things that go on globally were definitely affecting the price of gold, and still do to this minute.
Well, I noticed in a recent U.S. News and World Report article, it stated that Sweden's central bank had actually cut its key interest rate to a record low of minus 1%. I understand that 11 other countries have followed suit. So what does that mean when 12 nations have slashed their interest rates on savings accounts into the negative territory?
Isn't that an amazing thing? And people...
Unbelievable.
Yeah.
People wonder what in the world is going on, and it's a really good question. Why in the world is this kind of thing going on? And what it really means, if you dig right down to the rock solids of it all, is that the system's been abused to the point of almost no return between the debts and, issuing debt and buying back stocks and just making sure that all the derivatives are based on assets that are generally always rising. we've gotten into this situation of perpetual zero interest rates, and what people are doing, they were saying, well, you know what, I'm going to take my cash out of these banks. I mean, why in the world would I, leave cash in a bank and actually pay service fees? So the banks, they didn't retaliate by increasing interest rates. No, they actually started lowering to the point where you have to pay them to leave your money in the bank, which has caused even more people to flee the banks. And now they're talking, if you notice the alternative news sites, a lot of the headlines are about a big push to go to a cashless society so that you have no choice but to keep your account in a bank. It's really a wild time.
If you've just joined us, you're listening to the Accelerated Wealth Show. We've got Bob Rinear as our guest today. He's the editor of Invest Yourself newsletter at InvestYourself.com, and we're talking about what world events really have to do with your investments. If you catch this, you ever have any questions for us, feel free, give us a call. The number's 466-5634, where you can reach us. You can also join us for our last seminar before the summer. We're talking about what you can do to protect your retirement in the midst of all these uncertain world events, and those are this Tuesday and this Wednesday. Give us a call to reserve your seat. The number's 466-5634. So, Bob, it's interesting. You're seeing these different things happening. Tell us about oil. Obviously, oil just recently crashed this last year from about $115 a barrel down to a low of $45 a barrel. Yesterday it was back up to about $60. Why did that happen, and what did you see behind the scenes there?
It depends on how far you'll let your mind wander. Down the quote,
well, let's make it interesting. I mean, that's what people want to know.
All right. You have the mainstream version of what's happened, and then you have the reality of what's happened. And the reality is always darker, unfortunately. What we've got is a huge geopolitical situation playing out in the Middle East, and you can expand that, of course, up into Russia and Ukraine, Syria, etc. And there's a big war going on, a non-shooting war between Russia and the House of Saud, the Saudis, as to who gets the rights and the bragging rights to supply a lot of Europe with not only oil but natural gas. Now, Saudi Arabia isn't known for their natural gas, but their buddies Qatar right next door really are. They're one of the world's leading producers of the stuff. So the Sauds wanted to go up and run pipelines up into southern Europe, but to do that they had a problem. They've got this outfit called Syria standing in the way, and they're not very friendly with each other. And they know that Russia and Syria are pretty buddy-buddy. So realistically, what it looked like from everybody on our side of the fence is that they decided, you know what, in any time in the past, oil's been fairly self-regulated. When there was too much supply in the market, they would cut back the supply and just shrink the inventories. And the Saudis said, no, we're not doing that this time. We'll let the market figure out where the price should be. And the ultimate goal, of course, is that Russia, oil is 85% of their entire economy. That is a number that is just staggering, and I really believe that the idea was to drive oil down to the point where Russia would say, hey, you know what, we don't need Syria that bad, you guys can have it, and maybe they'd be able to get their pipelines laid through there. But, things like that go on around the world, and of course that kind of stuff doesn't make it to the mainstream. It's not allowed to be.
But why is that? It's so interesting. I mean, what the mainstream is saying right now is, it's the fracking revolution in the United States. They've created such a supply. There's now an overglut of oil oversupply, and that's why it's going down. And maybe it's the Saudis are saying, we don't want America to be a strong oil-producing nation, so we're going to drive a bunch of these guys out of business by keeping the supply high and driving the frackers temporarily out of business.
Oh, there's no doubt, as a secondary effect, they're certainly not going to cry if the frackers go away, but that's not what started this. A lot of the things that influence us on a daily basis are things that take place in faraway lands that really people don't understand. And in fact, if we have time, we have a huge situation coming up, and interestingly enough, we get a date on this one. It's going to be October, and that's when we believe that the Chinese are going to be included in the IMF's SDR basket. All
right, let's come back. When we come back, we're going to talk about the impact that might have, a huge date in October that could impact the economy globally. You don't want to miss this. You're on Accelerated Wealth with Chris Abeyta and Doug Berkey. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Hey, welcome back to Accelerated Wealth. We're talking to Bob Rinear, and he is the editor of Invest Yourself at InvestYourself.com, where you can find out more information. Right before the break, we talked about something huge that is going to have a global impact on the economy, and that is about China making an intro into the SDR. Doug, you want to explain what that means?
Well, the International Monetary Fund issues money credits in the form of special drawing rights. That's what SDR stands for. Presently, China is not included in that basket of currencies that comprise the SDR. I don't know the specific date, Bob, in October, but they will be included in that, which may have an impact on whether or not the United States stays the world's reserve currency. What's your take on that, Bob?
The date, we can narrow it down. We think it's October 20th, where we'll actually get an official announcement, but we're just generalizing it out into saying October. And so what's going on is that those SDRs that you talked about, what they are is a form of a reserve. And
a reserve currency?
Yeah, okay. As a form of a central bank, a sovereign nation's type of reserve where they can get credits or literally use these things to prop up currency imbalances on short terms and things like that. So they're fairly important. Most people don't know about them. They don't make the headlines at all. But that basket is currently made up of the U.S. dollar, the English pound, and the yen, and pound, dollar, yen, and I should know this, but anyway, they want in that basket really, really badly, and they applied back in 2010, and they didn't get in, and they made they made quite a bit of noise about that, and the IMF said, well, there's a couple things you need to do to get, when you apply again in 5 years. They only adjust it every 5 years, and that's why it's coming up this October.
So how does this impact? What's going to happen to the economy if they do get in? Is it already decided?
I believe it's already decided. We're just going through the show now. I believe that they are going to get in. Here's the thing, and this is what your listeners should pay attention to. Once the yuan, which is what we call their currency, the renminbi. Mm-hmm. Once the yuan is included in that SDR basket, it becomes a part of a global reserve system, just like the dollar has been the king dollar around the world. And some amount of countries and sovereigns are going to want to divest into that. Well, where are they going to get the money to do that? And what they'll end up doing is they will sell a certain portion of dollars on the open market, and so that they can raise cash to put some of that equity money right into yuans as a base of reserve. So I tend to think that we're going to see a weakness in the dollar when this happens. I think the yuan's peg to the dollar will kind of come free to some extent, or at least the bands will loosen up. But one other very interesting thing that I'm going to talk about over the weekend is that I think it very well might move gold considerably higher, and thus silver too.
Tell me about, let's talk about that, because gold has been kind of locked in place. There's a lot of tensions around the globe. Why is gold just stagnant right now?
Again, you got to put on your tinfoil conspiracy hat for that.
Okay.
You really do. I mean, I've been accused of wearing a colander on my head many times, but that's okay. If you look at the timing, gold was going very, very well since 2001. It was making great gains. And then in 2011, it came to a screeching halt just a few months, 5 months after the Chinese were turned down for inclusion in the SDR basket. And what the word on the street, under the street, if you would, is that the Chinese were rejected mainly because their official statements about how much gold the country has was not in proportion to the statements that you get out of the U.S. It comes right around that full circle again to where they say gold's an old relic and it's not money, but yet the IMF wanted to see them be able to support, say, approximately 3% of their outstanding currency could be backed by gold if needed. And they didn't have that in their official release. So what did we see for the last 5 years? We've seen gold retreat and then just be locked down, and we've seen month after month after month tremendous shipments of gold going to China. So I tend to think that gold was held down artificially so that they could acquire it, and I tend to believe that once they get in, some of that capping is going to take off.
What's your take on, is there any gold in Fort Knox?
I don't think that there's as much gold in Fort Knox as they say there is. Do I think there's some? Yeah. Do I think we have the standard reported 8,000 tons that they tell us? No, I don't. I believe a lot of that's been moved east over the years, and it's been bartered out and trade swapped over the years. So, no, I don't believe that we do have all of it. I believe we have some.
When we saw Germany ask for its gold back not too long ago, supposedly several hundred tons that was stored there, we were only able or willing to give them back 5 tons. How do you see that playing into this whole international scheme that's playing out right now?
That's just the point, is nations do indeed know how precious gold is, and they want their gold. They want it safe. Now, the reason that it was over here, the long-standing story is that they sent a lot of gold over here, especially just after the World War II, for safekeeping, afraid of maybe the Russians coming through or, some kind of political upset, more war. So we were safeguarding it here on our land. So you're right, when they requested, hey, we'd like to get a big chunk of this back, we couldn't come up with it.
That's scary.
Fact,
that is scary.
It's very scary. The stuff that we sent them was not even the bars that they had originally placed. The numbers didn't match.
We got a lot of things to ask about because you have so many interesting things. If you're joining us today, we're talking to Bob Rinear. He's the editor of InvestYourself. You can find more information at InvestYourself.com. But with all these different currency wars, we've got different, valuations going on. How do you see portfolios being influenced by this in the future?
I think, big picture look, you guys were just talking about a protect your wealth type of seminar coming up, and boy, nothing's going to be more important in the near future than that, because not only do we have these currency wars and we have this resetting going on around the globe as to who's going to be the lead dog, we also have to remember that we're 6 years pretty long in the tooth of a market that has been just pushed and pushed and pushed higher. So all of this stuff is really tending to come together at maybe a crescendo top here for a while. So I think that safety and caution is by far the name of the day.
Yeah, absolutely. If you're listening right now and you're concerned about all these different things taking place, Bob, you just said that the market has been pushed and pushed and pushed really by the driving of the Fed. There's a direct correlation with how much money's been printed and the stock market going up at the same time. And if we indeed are possibly at a crescendo, are you protected? If you're listening right now, and I talked to somebody just the other day that was walking into our building, and he was like, how's business? I said, it's great. He goes, a lot of people are nervous right now. They're just nervous about the market. It's just, bouncing around at these all-time highs, and people are expecting something. And it's important. We're pushing 7 years now since the last major market crash, and we tend to see 5 to 7 year cycles. If you're concerned about that and you're not sure you're going to be safe, maybe you're way overexposed, give us a call. The number's 466-5634. We can sit down. We can have a conversation. Take a look to see how exposed are you. Are you really where you want to be? Do you have any protection from major market crashes or major drops? Or join us at one of our workshops. The last 2 workshops before the summer's over, so you want to jump in these if you can. They're this Tuesday and this Wednesday. We do have just a few seats before we go into the summer, so the number's 466-5634 if you want to join us. You're going to learn how to protect your money. You're going to learn ways that you can actually see your account go up when the market is crashing down, and what some of those triggers are to actually know when to protect your money, and really how to build a plan in the midst of uncertainty and protect yourself from the next market crash. So if you're interested in that, give us a call. The number's 466-5634. Stick around. After the break, we're going to come into the next bottom of the half hour here. We're going to ask Bob a couple more questions specifically about the job market, the reality of the economy, and what you can expect in the near future. Again, you're listening to Accelerated Wealth, 466-5634. We'll be right back after the break.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Welcome back to Accelerated Wealth. We're talking with Bob Rinear today, the editor of InvestYourself newsletter, and we're talking about the real things that are happening that you don't hear on the news. Maybe they're conspiracy, but there's some real truth to basically what you're told, what you're not told. And Bob, before the break, we talked about the jobs market, or we mentioned that. Tell me, right now we're told that there's about a 5.5% unemployment rate, which means the economy should be smoking. I mean, people should be leaving one job because they're being attracted to another because there's such a low, supply of labor here in the United States. But when we look around and when people, what do you see? You're seeing the real thing. Tell us what you're seeing, what's really happening, and the impact that is having on us as an economy and a country.
Well, the jobs numbers that they put out are works of fiction. They should get Nobel Prizes for this stuff. They really should. It's really amazing stuff. Right off the giddy up, we've got approximately 101 million people that aren't even included in the math.
That's about a third of the nation.
Yeah, 1/3 of the entire nation doesn't even get included in the math. They say that these are people that are currently not looking for work or don't need work or whatever. Now, that's an awful large number, so you're already only dealing with 2/3 of the rest of the nation. And then the way that they compute the unemployment rate and the way that they've changed it over the years, every time it looks bad, they simply change the way that they account for things. So my pet peeve, of course, is the birth-death model. And I don't know if you're familiar with how that works. Oh, it's really, really pretty catchy. If you go to the BLS.gov, the actual Bureau of Labor Statistics, go to BLS.gov, and over in the top right, there's a little search box. Just put in 2 words, birth and death. And when you hit search, you'll pop up this page, and it'll tell you this month's adjustment to the birth-death model. Now, okay, what is that? Well, these spinnerheads got together and decided that, for every X amount of people that get laid off or a company closes, somebody runs out and opens a business and hires folks. Now, they don't have any tax receipts. They don't have any proof that any of these jobs exist. They literally make them up, come up with a number, and inject it into the non-farm payroll report.
That sounds like just printing money, just creating something out of thin air.
Yeah, it's exactly the same. And these injections of these bogus jobs, I'm not talking about 25 or 50. I'm talking 75,000, 100,000. A lot of times.
How can they do this, and how can they get away with this?
Because it's part of the scheme. It's the scheme of keeping things looking better than they are, and that's been every politician's goal since the end of the Reagan era. Everything has to be manipulated to look better. So we've had months over the last 12 months where if you didn't have the birth-death model figures injected in, it would actually be negative. We'd have lost jobs for the month.
Wow, that's an impact. So we're running around floating around. I think people know, though. People know the economy is not smoking. It's not strong. I think American ingenuity, despite what we've been up against, despite the current policies, have been attempting to really make a comeback and make things better. But things certainly are. What would you say is the actual unemployment rate right now? The real unemployment rate?
The U6, there's actually 6 readings of unemployment. And the one that we get reported to us in the mainstream is U3. But U6 includes all those people that are not in the numbers. It includes everything like it used to be 20 years ago. The U6 is running somewhere around 13%. And I'd say that's probably just a hair shy. I'd say we're at 14 or 15.
Wow. Bob, it's been fun having you. Thank you so much for sharing. And where can people get your newsletter?
Oh, I appreciate that, and thank you guys for having me on. I enjoy these chats. I really do. I'm at InvestYourself.com. Simply go there, and on the left side there's a sign-up box. Put your email address in. It's totally free. And when I say free, I don't want your credit card. I don't want your ad. I don't want anything. Okay. Just your email address, and you'll start getting a letter. It comes out twice a week, and take it for a ride around the block for a few months. See what you think. You bet.
I bet you there's a lot of fun and interesting things, far deeper and far more than we had a chance to talk to today. Go to investyourself.com. Sign up for Bob's newsletter. Bob, thanks so much for joining us today.
Take care, guys. Thanks a lot.
All right. Appreciate it. Doug, right there at the end, Bob said something really interesting. He said it's all about making things look better than they really are. And what that is, that's called deception. It's making people feel better about what may be going on when it's not really true. And, at the beginning of the show, we talked about, we mentioned target date funds. Are they working? Are they a trap? Will they really, really be there for you when you need them? It's interesting. Target date funds are becoming extremely popular. They're showing up in everybody's 401k now. They're in many people's retirement accounts, and people are just saying, and a lot of advisors are saying, pick your date. If you're going to retire in 2030, pick that fund. If you're really close to retirement, pick a 2015 or a 2020 fund. And it just kind of takes the brain work out of deciding what allocations to be in. The problem is, are they going to be okay? And there's a really big problem with target date funds. And so if you're listening, or if you're in a target date fund, you want to listen to this. And if you want more information, you want to come to one of our last workshops. If you're not sure what your retirement looks like, if you're getting close to retirement, if you're concerned about another market crash, remember what happened back in 2008. We're getting close to just being a 7-year anniversary from that, when the market crashed again. People's 401ks were turned into 201ks. Maybe you remember not even wanting to open your statements because it just made you sick to open them and to see the continuous carnage and the continuous losses. I want to tell you right now, that doesn't have to be you. And if you're in target date funds and you're depending on those, you might be in for a big surprise on how little you are protected from the next financial crisis. So come to one of our workshops. These are our last 2 workshops before we go for the summer. They're this Tuesday, this Wednesday. You can sign up. The number is 466-5634 to come. That's 466-5634. But here's what we're going to talk about. We're going to show you some concrete ways to protect all the market gains you've been getting over the last 5 or 6 years. We'll show you some ways to protect yourself when the market goes down. Also, we're going to show you some ways that when the market's going down, your accounts can actually be going up. You can actually be making money. Also, when the market crashes, how you can get out, or how somebody can help you get out at the right time. And just imagine that if you remember back in 2008 in the fall, when the market kept dropping and dropping and dropping. Imagine if right before those drops, you got a text message from your financial advisor from Accelerated Wealth that basically said, we have just recognized that the market signals are indicating a very high probability of a market crisis or market crash, and we have moved your accounts into a safe, no market risk position. How would you feel if you got that from your advisor and then you turned on the news and you saw the market dropping and red on all of those numbers, and you were able to rest assured in the fact that you were secure, you were safe, you were not participating in those bloody losses? If you don't have that kind of setup in your retirement strategy and your plan, come to one of our workshops or just give us a call. We'll show you what it is we do to protect our clients in the midst of a market crash, and how to make sure you're still growing and even your account's going up when the market is going down, how that's possible. The number's 466-5634. That's 466-5634. You can find us at acceleratedwealth.com as well. So, Doug, let's talk about those target date funds. How do they balance out between stocks and bonds? That's basically they're a mutual fund of stocks and bonds.
That's right. And the closer you are to retirement, so the next target date fund that would be available to you be 2020, is generally going to have about 70% of its allocation in bonds, Chris. 30% stock, 70% bonds. The problem with that is in today's interest rate environments, we're about as low as we can possibly go in interest rates. And when interest rates go back up, bonds go down in value. So you're being told by the traditional financial world that as you're about to retire, you should move about 70% of your money into something that is absolutely going to lose value when interest rates go up. There's no two ways about that. That's not a question mark. That's a mathematical certainty.
But bonds have always been the safe alternative to stocks, Doug.
They have been in the past, Chris, but in today's interest rate environments, interest rates can't go much lower.
Yeah.
And so when they do go back up, people unfortunately lose a significant portion of the value of their portfolio.
So what amazes me about this target date fund thing is it's the fallacy. Again, it's making something look better than it is. You're being told, hey, this is not as aggressive. It's safer, or probably the better term is it's more conservative because you're heavily loaded into bonds. But what you just said is so true. The problem is in a low interest rate environment, bonds are not any longer the safe place to be. And when we go into a financial crisis, we've seen that all those things go down at the same time. And if interest rates start going up, your bonds or the bond portfolio portion of that target date fund is going to very likely be in a really bad loss situation. And so there's this deception that a target date portfolio is going to serve you well.
Yeah, it's unfortunate because it's just the timing of it is really ill advised and not serving people well that are close to retirement.
So what should people be in instead of a target date portfolio if they're close to retirement?
Well, they have a couple choices, a couple major choices, Chris. They could be in some fixed investments. They could be in something like specific types of annuities that protect principal, participate in the growth of the upside of the market with no downside risk. One of the articles recently from Money Magazine said seniors have no business owning bonds at this point. An annuity acts like a super bond with no maturity date.
Yeah.
And then potentially some of our managed accounts that manage risk in a very efficient fashion.
Yeah, we're going to talk about those managed accounts at our workshop. We can also talk about how they can protect you from participating in huge market crashes while being in the market and getting the gains while the market's going up. So if you're in target date funds, or you have bonds in your portfolio, you're concerned about that, give us a call. We can do a free portfolio analysis for you. Take a look at areas where you might be more exposed than you think you are. Give us a call. The number is 466-5634. When we come back, we're going to talk about why the widow of the Home Shopping Network is suing Morgan Stanley for $170 million. We'll be right back.
Let's go back to Doug Berkey and Chris Abeyta for more about your financial future with Accelerated Wealth.
Welcome back to Accelerated Wealth with Chris Abeyta and Doug Berkey. We're picking up the story here. The widow of the Home Shopping Network is suing Morgan Stanley for $170 million. You can find this article online, but here's basically the deal. Linda Spear, she names the advisor, the branch manager, and the firm in an arbitration claim alleging excessive trading, negligent supervision, and unjust enrichment, according to the filing. So, Doug, basically it looks like they were going in and what's called churning the account. And what can happen, and I think I actually saw this from a client that just came in the other day. He was concerned about excessive fees in his account. And as we looked into it, what's going on here is one of the ways that a brokerage account can make more money on your account is by doing something called excessive trading. So they're trading one stock for another stock, one mutual fund for another, and constantly having this revolving trading. Well, what happens is if you're working with somebody that's not a fiduciary, you're just working with a broker, they don't have to do what's in your best interest. They just basically can trade and say they're doing this for your account. But they make money every time they sell and move into another position. They make a commission. So if they're running a little bit low, and you remember this from your days, maybe at Fidelity when you worked for them, if they're running a little low, you can, in your income that month, churn some of those accounts, make a few more sales, tell the client it was in their best interest or for them, but what you're really doing is padding your commission sales, your commissions.
Yeah, how's that different than our strategy, Chris?
Very, very different. You know, we have an actively managed account, and what it actually does is there's very little trading in it. The only time we trade is when our market triggers tell us you need to make a change to improve the profits because maybe one of the sectors in the economy are actually going up faster than others, so we change the slow horse for the fast horse. Or if there's a trigger that basically shows that the market's about to go into a dip or very likely go into a long-term bear market, which we've been able to trigger before, and then move into positions of safety or actually profit when the stock market's going down. Now, what's different about what we do, Doug, is our trades only cost $8.95. We won't make any money when we trade. So there's no profit when we trade. It's just we don't get paid on a trade. We basically, the only time that we get paid or get a raise is when your accounts go up. So when your accounts go up, we get a raise.
Well, many of our trades have no cost, Chris.
Yeah, about half of those trades actually have no cost because they're inside the Charles Schwab platform. And when you go from one Schwab to another Schwab exchange-traded fund, you don't have any fee for that, and there's no fee charged to your account. So, maybe you're in a situation where you're in a brokerage account and you're just curious about your fees. You see that you're paying an advisory fee, which is fine because you always do that, but maybe you're seeing excessive trading fees or you're wondering if that's the case. That may be a dangerous position for you to be in, and it probably means usually you're in a very high percentage of stocks, some bonds, and mutual funds, which means you have a pretty aggressive portfolio. If that's a concern to you and you feel like maybe you're getting too many trades, maybe you're paying too much for that service, and maybe you're not as protected as you want to be, we'd be happy to do a free portfolio review for you. You can also come to one of our workshops where we show a strategy, and we'll actually talk about one of our managed account portfolios that has much lower trading fees and has performed very, very well. We can't talk about the percentages and the numbers here over the air for compliance reasons, but we can certainly go into more of it in person. So if you're interested in that, the number's 466-5634. That's 466-5634. Sit down, have a cup of coffee, talk over your portfolio, or join one of our workshops. We have 2 workshops coming up. These are the last 2 workshops, this Tuesday and this Wednesday. They're the last ones for the summer before we stop doing these. So they will be limited. You can give us a call to jump in, learn about these managed accounts, learn about strategies to protect your wealth when the market's going down, but also how to be in the market and invested in the market to make money when it's going up, and how to transition safely from being close to retirement to when you're actually going to go into retirement. The number to call to reserve your spot is 466-5634. That's 466-5634, or check us out online at acceleratedwealth.com.
Chris, about 2 weeks ago, April 27th, FINRA put the brakes on a nationwide financial group for lying to elderly investors.
Now, this wasn't nationwide, just to clarify, but
yes,
it was
a nationwide financial group
Okay.
that offers products. You would recognize their name. We choose not to throw them under the bus, but you have to wonder if you happen to have any money with these people, and why were they being not only investigated but shut down? And the bottom line is, if you're not dealing with a fiduciary, somebody that by licensure has not only a moral obligation, but a financial obligation to make sure they put your best interest first, no matter how nice the person may seem you're dealing with. What we've seen, Chris, from folks like Greg Indovina and many others who used to work with some of these major firms, is the firm's primary focus is to keep you in the market at all times. Mm-hmm. That's their focus. It's not, are you making money? Are you losing money? It's, can we keep you in the market at all times so those fees are continually generated? It's
interesting. It's less about, many times, and this is what Greg said when he worked for the Big M company. He said it was less about managing the client's money. It was more about managing the client. And so a lot of times when you're in a stock, bond, mutual fund portfolio, you don't know if the market's going up. The hope is that over time it will go up for you. And so their tactic then is just keep you in, buy and hold. The market always goes up over time. The problem is, as you get closer to retirement, you can't weather a major market drop anymore. You don't have the time to recover. And there's something called sequence of return risks. If you get retired and you're 1 or 2 years into retirement and you lose a significant portion of your portfolio while you're taking money out because you're taking money out to live on it, the dramatic effect, and there's lots of studies done on this, you could potentially run out of money 13 years earlier just by having a bad year early in your retirement compared to a good market year. And that's something you can't control. You don't know how those cards are going to get dealt. That's why we do things very, very differently here at Accelerated Wealth when we build your retirement strategy. So, Doug, we talk about a lot of things. Let's talk about some of the things that we do for our clients that makes a big difference and really brings people a sense of security and a sense of peace of mind once we've put together their retirement strategy.
Well, interestingly enough, Chris, very few people tend to maximize their Social Security. And there are 1,100 different potential strategies for a husband and wife to maximize their potential. The Social Security Administration itself says there's about 94% of the folks that don't maximize their potential from Social Security.
Wow.
And, of course, they have no vested interest in helping you with that. So you have to depend on outside education.
Tell me what the difference can mean for a couple if they maximize their Social Security versus just take it at 62.
Well, we've seen cases, Chris, where it's been as much as $100,000 or $200,000 over the course of people's lifetime by doing it properly versus what they were intending to do before they understood the choices.
You know, who wouldn't want an extra $100,000 or $200,000 into your retirement plan? You got to look at Social Security as an asset. It's something you've paid into. It's something you've earned. And now you got to figure out how to extract the most out of it based on your expected lifestyle, how long your life expectancy, if you're married. Doug, how many ways are there to actually take your Social Security? 1,100
different ways, Chris, for a married couple, and it represents approximately 36 to 40% of most retirees' income in retirement. So why would you not want to study that just as thoroughly as other options in your retirement plan? And if people can bring us their benefit numbers, we can create their own 16-page customized report, which will give them some great strategies.
You know, that's free. If you're interested in getting that report, give us a call, 466-5634. Ask for Doug. Say, hey, Doug, I want that Social Security report. We'll be happy to gather some information from you, get that for you, and then actually walk you through it. If you want to learn more about the Social Security strategies, you're doing a workshop this week. It's the last two workshops of the summer, before the summer. That's Tuesday and Wednesday. And you can join that workshop by calling 466-5634. We have two workshops going on. We have one on specifically on retirement strategies and then one on Social Security. So when you give us a call, tell us which one you want to sign up for. That's 466-5634. That's this Tuesday and this Wednesday evening. They are the last ones of the summer, so you jump on these. They are filling up, and we were full just earlier this week on the other two we were doing. So again, 466-5634. Something else that we do, the last couple things, Doug, with the little bit of time that we have left, you label them here pension rescue strategies. Give me the headline on what it is that we do for that.
Well, many folks, when they are retiring, they want the maximum amount of money they can get in their retirement benefit. So they take a benefit that leaves their wife losing a portion of the benefit. Typically, it's the guy. We see this with most often. And many times they'll take a 55% survivor benefit. So in other words, the spouse loses 45% of the pension, and they'll lose one of their Social Security checks when that first person passes. And so it's important to put something in that stopgap that allows you to turn on additional income to make up that shortfall. We've seen people lose as much as $50,000 and $60,000 in a year. And I know for me and for most of the guys listening, we've worked our whole lives to take great care of our wives. We don't want to stop when we're gone.
Ladies, if you're listening right now and this makes you nervous or uncomfortable, we do this all the time. But we'll help you identify how much you're going to lose if you lose your husband, and we'll show you how to replace that and make sure that you're going to be taken care of. So that's called our pension rescue strategies. Come in, give us a call, come to our workshop this week. We can help you with that. Doug, the other thing we do is we help people pull together all their old orphan 401ks that are straggling and left out there. And basically we help you hitch those myriad of accounts that you've got all over the place, hitch all those horses to the same cart and begin the effort of pulling those carts together, going the direction that you want to go, making your money work hard for you. So those are just a few of the things that we do every day. We have the privilege, of doing that for wonderful people just like you. And if it's not been done for you yet, let us help you out. Come to one of our workshops this week. Meet us in person. These are Tuesday and Wednesday, the last ones of the summer. before the summer, or give us a call and just come and visit with us. We'll have a cup of coffee. We'll sit down and see what we can do to serve you and help you create that peace of mind in retirement that you're looking for. The number's 466-5634. Thanks for joining us here on Accelerated Wealth.
The opinions on this radio talk show are those of Mr. Abeyta, Mr. Walton, and their guest speakers, not necessarily those of Accelerated Wealth, LLC. The radio talk show may contain forward-looking statements, including but not limited to statements as to future events that involve various risks and uncertainties. Forward-looking statements involve known and unknown risks, uncertainties, and other factors that may cause actual events or results to differ materially than those that were forecast. Therefore, no forecast should be construed as a guarantee. Investing in security and annuities involves a risk of principal loss. Prior to making any investment decision, a listener should consult a professional to determine the risk, benefits, fees associated with a particular investment. Info obtained by a third-party resource is considered reliable, but accuracy cannot be guaranteed.